The concept of materiality. This segment's learning objective is to explain the concept of materiality. The concept of materiality allows accountants to use estimated amounts and to ignore certain accounting principles if these actions will not have a material effect on the financial statements. A material effect is one that might reasonably be expected to influence the decisions made by the users of financial statements. Thus, accountants may account for immaterial items and events in the easiest and most convenient manner. Materiality refers to the relative importance of an item or an event. An item is considered material if knowledge of the item might reasonably influence the decisions of users of financial statements. Accountants must be sure that all material items are properly reported in financial statements. Immaterial items are those of little or no consequence to decision makers. The financial reporting process should be cost-effective. That is, the value of the information should exceed the cost of its preparation. Immaterial items may be handled in the easiest and most convenient manner. The concept of materiality enables accountants to shorten and simplify the process of making adjusting entries in several ways. For example, businesses purchase many assets that have a very low cost or that will be consumed quickly in business operations. Examples include wastebaskets, light bulbs, and janitorial supplies. The materiality concept permits charging such purchases directly to expense accounts, rather than to asset accounts. This treatment conveniently eliminates the need to prepare adjusting entries to depreciate these items. Some expenses, such as telephone bills and utility bills, may be charged to expenses as the bills are paid, rather than as the services are used. Technically, this treatment violates the matching principle. However, accounting for utility bills on a cash basis is very convenient, as the monthly cost of utility service is not even known until the utility bill is received. Under this cash basis approach, the amount of utility expense recorded each month is based on the prior month's bill. Adjusting entries to accrue unrecorded expenses or unrecorded revenue may be ignored if the dollar amounts are immaterial. Whether a specific item or event is material is a matter of professional judgment. In making these judgments, accountants consider several factors. First, what constitutes a material amount varies with the size of the organization. For example, a $1,000 expenditure may be material in relation to the financial statements of a small business, but not to the statements of a large corporation such as General Electric. There are no official rules as to what constitutes a material amount, but most accountants would consider amounts of less than 2% or 3% of net income to be immaterial, unless there were other factors to consider. Another factor is the cumulative effect of numerous immaterial events. Each of a dozen items may be immaterial when considered by itself. When viewed together, however, the combined effect of all 12 items may be material. Finally, materiality depends on the nature of the item as well as its dollar amount. Assume, for example, that several managers systematically have been stealing money from the company that they manage. Stockholders probably would consider this fact important even if the dollar amounts were small in relation to the company's total resources. We identified 4 types of adjusting entries, each of which involves one income statement account and one balance sheet account. The effects of these adjustment types on the income statement and balance sheet are summarized here. We have highlighted just a few of the adjusting entries prepared at the end of December 2018. Like the trial balance, the adjusted trial balance shows that the total of the debit balance accounts is equal to the total of the credit balance accounts. Our books are in balance after recording our adjusting entries. After these adjustments are posted to the ledger, overnight's ledger accounts will be up to date, except for the balance in the retained earnings account. Improper accounting for operating costs has often resulted in the SEC bringing action against companies for fraudulent financial reporting. Expenditures that are expected only to benefit the year in which they are made should be expensed or deducted from revenue in the determination of net income for the current period. Companies that engage in fraud will often defer these expenditures by capitalizing them. They debit an asset account reported in the balance sheet instead of an expense account reported in the income statement.